Hello and welcome to LiveWire's Views from the Top, our newest series dedicated to bringing you the best ideas and insights from those at the top of their game. I'm Ali Selby and today we're very lucky to be joined by Lennox Capital Partners Principal and Portfolio Manager James Dougherty to talk all about small and micro caps. Thank you so much for joining us today, James.
Thanks for having me, Ali.
As our audience may know, the Small Ords Index hasn't really performed well over the last few years. Why do you think that is?
Look, that's a good point. It has been a hard few years for the Small Ordinaries Index, but the point I'd make first is it's generally not a great performing index. If you look over any extended time frame, the returns for the risk of the asset class are pretty poor. I've brought in a chart that I think best explains why this occurs. So on this chart, what we've done is we've charted the total shareholder return of every company that has been in the Small Ordinaries over the last decade. There's been roughly 600 companies that have been in our investment universe. At any point in time, the Small Ords is made up of 200 companies, but those constituents change, and so over time we've had 600. If you look at this chart and start on the left-hand side, you'll easily figure out why this is an underperforming benchmark. On the left-hand side, we have the superstars, we have the top performing companies that have provided, really significant returns over that decade. As we track to the right, we'll notice that the returns diminish, and then you end up with this cohort on the far right that have been pretty capital destructive. I think the return is roughly about negative 70% over that time frame. And so what's occurred is that all the great performing companies on the left-hand side have been largely offset by the businesses on the right-hand side, and you get an index that returns, say, 6% over any time frame. The one thing I would highlight also, I think it becomes very clear, is that the best way to outperform this, or perhaps the easiest way to outperform this index, is just not be invested in those businesses on the far right. If you did nothing else but didn't invest in the bottom third of that index, your returns would double to around 12%. Addressing your first question, where you said the index has performed pretty poorly over the last 3 years, it's basically flat over 3 years. If you are a believer in mean reversion and the long term is 6, maybe it's not a bad place to be Australian small caps for the next few years.
Okay, you talked about the dispersion of returns in the Small Ords Index just now. How can investors avoid those capital destructive investments when searching for small and micro cap gems?
Yeah, look, I think there's a number of factors that are really good red flags for what could become a terrible investment. The first one is governance. Terrible governance is a killer for a company, but also a minority investor. So it's really important that the board has experienced, strong directors that will hold management to account, ensure that they're executing on their strategy, and if they're not, act swiftly. We also want independent directors looking after minority investors, so if the business is a success, hopefully that wealth trickles down to the minority investor. Other factors we look at would be, is their product or service commoditised? Are there barriers to entry that mean the margins maybe are not sustainable at the current level? Is there social or environmental impacts that are negative from their business model? The reason we care about that is generally if there are negative impacts, what's going to happen is that regulation will be introduced or consumer behaviour will change, and you'll see those earnings disappear. I would also add earnings quality, looking at the cash conversion, look how they generate their revenue and is it recurring. And then finally, which is tricky, but probably the most important, is management, the quality of management. So it is a hard quality to get your head around because quite often it is just a personality contest, and management teams are generally pretty good at being good people. On the facade at the very least. So what we try to do is look for data points, try and remove the subjectivity from it. So look at their track record, look for examples of good execution, and look at their remuneration, look at their how they're incentivised. Generally, how they're incentivised is how they will behave.
Lennox Capital has a 4-step repeatable process for identifying opportunities. Can you take us through that?
Yeah, sure. So look, the first 2 steps are very much focused on identifying those businesses where we think we have a competitive edge. So we use a range of qualitative and qualitative screens to identify a really narrow list of businesses where we think, okay, we can forecast and value their earnings. Is this business mispriced at the current point in time? Step 3 is the fundamental research. So that's the bulk of our work. It's probably the most fun part of our job. That's where we get to do lots of meetings, get introduced to new industries, new companies. We do around 500 management meetings a year.
Wow.
We do financial modelling on every potential investment. We forecast the earnings for those companies, and ultimately what we'll put together is an investment thesis. So it's pretty comprehensive. And then step 4 is portfolio construction. Liam and I both spent a lot of our lives at Macquarie Group before we started Lennox. And Macquarie had a really strong culture of risk management and being process driven. So that's, I think, burnt into our brains at some point. And so when we're doing our portfolio construction, it is all about maximising return for deliberate risk and understanding that risk very well.
I want to turn to M&A activity now. Obviously, M&A activity is starting to heat up after a pretty slow 2023. Are there any small or micro cap opportunities that you think could be takeover targets over the next 12 months?
Yeah, look, we wouldn't ever specifically target an investment because it could be an M&A candidate, but an investment we do have that we think has the potential to be taken over is PEXA. So PEXA owns and operates a software platform that facilitates conveyancing. It effectively enables the settlement of the majority of housing transactions in Australia. It's a really high quality business, so it's got high margins, a really dominant market position, good cash generation, and a number of growth drivers still within the business. The board decided to try and replicate the Australian business and do it in an offshore market, so they went to the UK. And not surprisingly, they discovered that it's taken a lot longer and it has cost way more than initially thought. So, and listed equity investors have become frustrated with the situation. So if we look at the business today, the Australian exchange business is probably worth around $16. PEXA's share price is $13.50. So you're effectively being penalised $2.50 for the international business. Now, I'm pretty sure we're not the only ones that are doing that math.
Speaking of M&A activity, Lennox owns both Superloop and Aussie Broadband. Can you take us through some of the drama there and whether or not you're going to be staying invested in both of those companies, I guess, throughout that deal activity?
Sure. So yes, there's certainly been plenty of drama. Yes, we are still invested. We've been long-term investors in both businesses. We actually invested in Aussie before its IPO. We helped it come to the listed market, and Superloop we've been invested in for a few years as well. Admittedly, we did sell some shares in Aussie after the February results announcement, and the share price performed because it was a pretty strong result, but that was before the acquisition announcement. If I kind of look at both sides, as an Aussie investor, we believe that it was a good idea to try and buy Superloop. Great idea, take out the nearest competitor. There's enormous synergies available when you put these two types of businesses together. Conversely, as a Superloop investor, we were pretty disappointed with the price that Aussie offered at 95 cents a share. We thought that was Aussie trying to get it too cheap. Evidently, so did the Superloop board, and they didn't engage with Aussie. And then Superloop has now gone a step further, managed to win over Aussie's largest white label client, Origin. It's also tried to force Aussie to sell down the 19.9% it bought of Superloop before it announced the acquisition. It's really difficult to say what will happen. What I will say is it will probably take lots of time and lots of lawyers. But in the interim, we're very mindful that if it doesn't impact the operational performance of both businesses and the valuation is still compelling, we'll stay invested.
What do you think is the ideal outcome from that deal activity?
I think as a Superloop investor and an Aussie investor, I would hope that Aussie is able to acquire Superloop. They get the synergies, we get the bump in the share price for the acquisition in Superloop, and we win on both sides. I'm not sure if that's going to happen anymore because both share prices have gone in a different direction.
In preparing for this interview, you told us that you believe that markets are inefficient. Can you take us through your reasoning there?
I do believe markets are inefficient. If markets were efficient, I wouldn't have a job or a business. But we do believe that you need a catalyst for those mispricings or for the market to be inefficient. We believe that catalyst is change. Change to us sits in three broad buckets. So you have structural change within an industry. So think about, the best example I can give you is we saw an enormous transfer of market share from the old newspaper classifieds to the online marketplaces, realestate.com, Seek, etc. That was structural change occurring over that decade or so. We believe that the impact on the earnings of both sides of that change is not accurately priced into the share prices in the short term. So there's an opportunity there. The second type of change we see is cyclical or economic change. So as the economy goes through troughs and peaks, that different operating environment is going to have a material impact on companies that operate within Australia. We believe again that the market doesn't capture those changes in earnings efficiently in share prices. And then finally, probably our favourite type of change is company-specific change. So something changes within, say, the service, the product, the personnel, or the strategy of a business that is going to have a material impact on their earnings. Again, we do not think the market captures that in the share price quickly.
Okay, you talked to one example there. Is it possible you could provide our audience with an example where you are seeing mispricing within the small and micro cap area of the market today?
Yeah, sure. I would point to perhaps oOh!media. So oOh!media is undoubtedly the beneficiary of a structural change that is occurring within the ad market. They're an out-of-home media business. Out-of-home has gone from around 10% of ad spend to 15% in the last decade, and that's within a time frame that we all saw a significant lockdown. There are a couple of drivers of that structural change. So first we saw there was technological development that enabled the digitisation of outdoor screens and also better measurement of outdoor audiences. And then we've also seen just a general change in consumer behaviour that has seen legacy mediums like TV and radio see a massive decline in their audiences. So if I look at last calendar year, out of home as a segment grew by about 15%. The broader ad spend was negative 3%, but we feel that oOh!media is still being unfairly bucketed in with those legacy media companies that are listed on the ASX.
In the intro for this interview, I said that Lennox Capital focuses on businesses that could become next generation ASX powerhouses. I'm going to push you to name which stock you think is the ASX's next generation powerhouse, maybe the next 10-bagger.
Look, I probably wouldn't like to predict a 10-bagger, that's quite difficult, but if I had to name a business that I think has the potential to be a next generation powerhouse, it would be Megaport. So Megaport owns and operates a software-defined network, so an SDN, and really in simple terms what that is that they own a network of fibre cabling around the world that is connected to data centres, to cloud service providers, to software providers. And then they have a layer of software above that that enables their clients to move data easily from these providers and effectively around the world. This business, I would say, lost its way for a couple of years. And we saw the share price go from around $20 odd to $4 through that time period. That change in share price for us was a catalyst to do more research on the business. And what we discovered through that research is that the business has a really high net revenue retention. Now what that means is that their existing customers use a lot more of Megaport's product and services every year. So they've got some really good revenue growth from their existing customers. The problem with the business was it wasn't attracting new logos and new services, and that was disappointing the market because the market was very focused on their market penetration. What we've seen now is that there's been a change in management. So Michael Reid has come in as the new CEO, and he's brought with him a new change, a change to their go-to-market strategy. That go-to-market strategy makes sense. We've seen some early wins that may tell us that the logo growth or the new client growth may resume. So if you can combine client growth with a growth in your existing client spend, that can be really powerful as a driver for revenue. The kicker that I would say for Megaport that perhaps gets everyone a little bit excited is there is pretty good potential for exposure to AI longer term. So right now there are a number of data centres being built around the world, and their specific function is to provide computing power for machine learning. So the need they have for bandwidth and the amount of data they need to transfer on a fibre network is many multiples of that Megaport has historically provided for their customers. So if they do get exposed to this type of work, then you would see that as a significant driver of their revenue.
Okay, Megaport is already quite a big company and its share price has done exceptionally well this year. How much bigger do you think Megaport can get?
The business can get a lot bigger. The one thing I will say is that Michael Reed's new go-to-market strategy, which effectively moves away from offering products and services which are highly technical to their customers, to offering solutions, has probably increased their addressable market enormously. You add AI to that market, and then the potential revenue that they can generate over the medium to long term is very high. The added bonus is that there is a lot of operating leverage in this business. So the fibre network they have today is the utilisation still pretty low, and additional CapEx sees a high return on investment if the utilisation improves. So I'm not going to give you a number, but there is really large potential if they get the strategy right.
Okay, we've talked about a lot of businesses that you're really liking today. I want to go the other side of that. What's a business that you've recently sold out of?
We recently exited our investment in corporate travel management. We were in corporate travel partly because Jamie Ferris is a very good operator, and we backed his strategy to grow market share and also participate in the recovery in business travel, which we're still seeing globally. From the result in February, we've started to suspect that perhaps they're starting to lose market share out of their US acquisition that they did during COVID. So our rule is that if one of the key drivers of a thesis breaks, we exit that position. So we've exited the position. We're certainly will continue to engage with the business and watch closely, and I would suspect that Jamie will be able to get on top of things, but it may just take a little while.
Okay, last question for today. We ask all our guests on Views from the Top the same question to finish off the interviews. What's something that you've learnt recently that you think you wouldn't have learnt if it weren't for your decades in markets? What's your unique view from the top?
You did warn me of this question, so at least I've had some time to think about it. And I would say what I've probably learnt from the 20 years now that I've been in markets is that I think the value of admitting you're wrong is probably higher than the value of actually being right. You can't kid yourself that there are a lot of really smart people doing really excellent work or research in the listed market. If you think that that alone is going to differentiate you and give you longevity, I don't think it's going to. It's the ability to admit you're wrong. Ideally, you've got a process and you've got colleagues that will help you. That become apparent really quickly. But if you can admit you're wrong and ensure that a bad investment decision doesn't become a disastrous investment decision, I think that's how you achieve longevity in this industry.
Okay, well, thank you so much for your time today, James. I really enjoyed that interview.
Thank you. Thanks for having me.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.